And that's perfect. Well, welcome once again, members and guests, to another Sharewise webinar. We're very lucky today to have the director, Dr. Donald Hamson, with us today to talk about Plato Income Maximizer. So I know that a lot of people out there have been looking for some great dividend-looking stocks. This is a very interesting one indeed. So I might let Donald talk a bit more about this, but in particular, Donald, what got you interested in starting up and working with Plato in particular?
Well, I'd worked for a number of fund managers, such as State Street Global Advisors, which are one of the biggest fund managers in the world out of Boston, and Westpac Investment Management before it, as it merged with BT and Rothschilds, and went on to become BT Investment Management, then was bought by Perpetual, etc. And I was probably a bit frustrated by working for institutions where, such as suddenly someone decides they're going to merge three fund managers into one, so trying to be your own boss, I think, is a good thing, and I think we've got got plenty of experience at running sort of a product such as the Plato Income Maximizer and its underlying share strategy. So, but yeah, I've always been interested in my shares, and probably because my dad had a share portfolio too. So
Absolutely,
that's my
absolutely.
back.
Well, for our members and guests that just joined as well, if you want to submit any questions, we will do a bit of a brief Q&A at the end. But apart from that, obviously, there's a few people that are very new to the stock. What could you tell us about Plato Income Maximizer?
Yeah, so Plato Income Maximizer is a listed investment company. I can actually just go through a couple of the slides. The all-important disclaimer. But if I move to the next slide, the Plato Income Maximizer, I'll call it PL8 because that's its ticker. It's the first and to our knowledge, the only listed investment company that pays monthly dividends, and they're fully franked. It's aimed primarily at retirees who want that regular income. It was listed just over 7 years ago in May 2017, but it's based on a strategy that we've been running since 2011. So it's got coming up for 13 almost 13 years of history. That is the Plato Australian Shares Income Fund. So that's a listed fund, but this is an unlisted fund, and but the actual listed company invests into that fund and receives the dividend stream, or owns the investments and receives the dividends that come out of that fund and the franking credits. As I mentioned before, it's designed really for retirees who want that regular income and also love fully franked income, because they usually get a full refund of the franking credits if they're in a super fund, or at least if they've got less than $1.9 million now. Why did we list a company as well as have an unlisted fund? Well, the company enables us, or PL8 enables us to, if you like, bank profits and bank franking credits. That's what company structure does. And so we can build up a kitty of retained earnings and franking account balances for a rainy day, and then we can pay out this smooth monthly dividend stream. So in the fund, it pays somewhat lumpy quarterly, or distributes lumpy quarterly income, but the company itself pays a smooth stream of dividends. And I think a lot of people love that regular income, because once you're retired, you no longer receive a salary. Lachlan, you and me get a monthly salary. It's very regular. You rely on it, pay the bills, etc. But most companies in Australia only pay 2 dividends a year. And if you're only paying 2 dividends a year, it's a long time between drinks if you're relying on that income. So we raised initially just over $300 million. We've done a number of subsequent raises, both placements and share purchase plans, and the fund, or the company, has now grown to over 900 million. And if I look at, just to highlight that, we are delivering on what we said. If you actually look through at the history of PL8, it has paid regular monthly dividends since October 2017. announces them at the start of each quarter and pays regular dividends. We did reduce dividends slightly in the pandemic because a lot of companies stopped paying dividends, but then we subsequently increased the dividends, and now they're at an all-time high of 5.5 cents a share and have been for the last couple of years. So, you get that regular dividend stream. On top of that, there was actually a 3-cent special paid on the, in response to the risk that the ALP might get rid of franking credits. So we actually paid out some of our franking. In hindsight, probably wouldn't have done it, but we didn't know they'd lose the election. And we did pay a birthday special dividend on our 5th anniversary.
Yeah.
And unlike many, I suppose, LICs, we've almost always traded at a premium to NTA. This chart might be a little hard for the viewers to read, but it actually, the light blue line is the share price of PL8, and the black line is the underlying NTA value over time. And you can see that for the vast majority of the life of PL8, the blue line is actually, so the share price is above the actual asset values. So we've traded generally at a premium. The only time we didn't trade at a premium was actually around that time that the ALP were advocating to get rid of the refund of franking credits. And but once they lost the election and scrapped that policy, it went back to a premium and has traded at a premium since. Even in the dim, dark days, which is now a bit over 4 years ago of the pandemic, when the market collapsed sort of 30% in a short period of time, PL8 traded basically in line with its NTA and then rebounded again once people realized that it wasn't the end of the world. Absolutely. So it is one of the few LICs that has traded at a premium. And I'm just going to go to one more slide and highlight the value, I think, of fully franked dividends and why retirees like them. On this slide, I'm looking at the, I might actually show a couple, but on this slide, I'm looking at the after-tax value of $1 of pre-tax income. And if you are tax exempt or in a pension fund, you get a full refund of franking. So if you received $1 worth of PL8 dividends, so you had, 20 or so shares, you get about $1 worth of dividends. That actually, when you get the franking credit refund, be worth about $1, or just a bit over $1.40. So franking credits are very valuable for retirees who are tax exempt. They're actually pretty valuable for everybody, to be honest, but they're certainly very valuable for super taxed at 15% as well. Not as valuable as they're in retirement mode or as in tax exempt, but they're very valuable. So, and they're only available to Australian residents. So we try to make the most of that, and we try and target actually the companies that we tend to invest in. We don't exclusively invest in them, but we prefer fully franked dividends. So we have a very active investment process, and we go and purchase stocks that are largely paying fully franked dividends.
Absolutely. Absolutely. Well, obviously, we had a few questions come through a bit earlier via email, and members and guests, if you want to submit some questions, we're happy to ask a few of those. Yep. But for yourself, Donald, what really separates PL8's strategy and risk management from your competitors? What makes your company more attractive?
Well, I think the first one is that it's the only one that pays monthly dividends. So if someone's looking for very regular dividends, fully franked, then there really is no competitor on that front. There are a few competitors that are sort of more income related. Obviously, I think a lot of LICs, people are looking for income off them, but they only pay those dividends usually every 6 months. So that's one feature. I suppose the other one is that we don't use derivatives, options, or any other strategies to try and generate the income. What we do is we very actively invest in Australian equities. We're active traders. We buy stocks for income, and we trade around dividend events. So, we're quite different to some of the more buy and hold strategies, I think, that are out there, both on LICs and ETFs for that matter.
Absolutely. Absolutely. And as you stated, you had 900 mil funds under management just recently. Your target was up to 1 billion. Obviously, we're getting very close. What's the next target that we have in mind?
Look, I think we'll be satisfied if we get to $1 billion. One thing, we don't want to do is become too greedy and grow the company too big and not be able to actually continue with the strategy that we have. We only have a limited capacity in that strategy. And remember, we have about another 1.5 billion in bit over 1.5 billion dollars external money in the underlying unlisted fund. So we're running over $2.5 billion in this strategy already, and we think we can grow at another 100 or maybe 200 million, but not much more than that, because we don't want to become an index fund. We want to continue to be actively managed, and we want to continue to be able to distribute high levels of income to our clients. And that's why they like this fund. And so the problem, I think, with some fund managers, they get too greedy, they run too much money, and their previously successful active strategy starts to look more like an index fund, and then they're not satisfying their objectives. And our objectives are twofold, which is interesting. Obviously, we're an income fund, so we try to generate that higher than market income that's distributed regularly. But the second thing is we also want to try and beat the market after fees over time, so outperform the market, because that's why you're paying us a fee, because we hopefully can beat the market in terms of total returns, but in particular for retirees, giving them high levels of income along the way.
Okay, and so in taking into account that, it doesn't really sound like a cap raise anytime would be on the cards, really.
Yeah, we got to look at it closely, and given the limited capacity we have, we may not do another raise, and it depends. We have a couple of other sort of institutional clients that might leave the underlying fund. If that happens, we might have an extra capacity, but we keep watching the space, I suppose.
Absolutely. And with your plans, obviously being an income maximizer, is there plans to get into the US market a bit more and maximize off dividends across the board, have a bit more diversification?
Well, we already have actually a global income fund. Now it's much smaller, and it only delivers about a 6% yield, because there's a lot less opportunities. You don't have franking credits, and particularly in the US, you don't have high levels of, companies actually don't pay much dividends at all, most companies. In fact, interestingly, their tax system is the exact opposite of ours. The franking system in Australia actually encourages companies to pay out fully dividends if they made profits and paid tax. So there's an incentive to actually pay out those franking credits. In the US, they still have a double taxation of dividends sort of tax policy. So companies often don't pay dividends at all and just buy back stock, because capital gains tax rates are lower than dividend tax rates. So quite a different regime. So you can, Australia is the place to get very high levels of income. It's the only place to get franking credits. It still works. We can generate about 6% from that fund. But if we look at the underlying unlisted fund, which is trading at NTA, we've generated about 9% of income, including franking, since inception. And franking's nearly 3% of the 9%. The problem globally is you can get almost about the same cash level of income, about 6%, but you don't have the franking credits, which is very attractive for Australian investors, as I showed.
Absolutely. We do have a question that's come through. The question asks, as a fund manager, what has been the drawback of the unlisted fund at the moment?
Well, I suppose the drawback is that you get the income paid quarterly, and it's somewhat lumpy. We don't smooth it. In the long term, if you're a long-term investor, you should get the same amount of income out of either strategy. It's just one's listed, the other's not. I mean, the other drawback, I suppose, which is a common drawback of listed funds, is that, or unlisted funds, sorry, is you got to fill out like a 20-page application form. And I keep saying, can we simplify this?
Yeah.
And our risk and compliance say, no, you can't, because ASX says you got to fill this out, and you got to fill that out, and you got to do this, and you got to do that. And so it's quite cumbersome. And I think that's the other advantage of the listed market is that once you've set up your account, whether ComSec or whoever it might be, you can just go and trade things very easily because you've done your sort of, you've had to provide those details of who you are and what type of investor when you set up your broking account. And then it's very easy to trade and buy new ones. You don't have to fill out messy application forms.
Absolutely, absolutely. And probably our final question, unless we have another one pop up, with reporting season coming up and increased volatility, what's your expectations for the market, and how are you more or less looking to generate some growth and income during this period?
Well, look, I don't know whether it's going to be increased volatility or not. I mean, I think we've seen now for the last 18 months people getting used to an interest rate rising cycle. Hopefully we won't see another rise in interest rates over that time period. I think that would make it much more volatile.
Yeah.
But I mean, I think we've been in a sort of holding pattern for a while, and people are seeing that we're seeing slowing in sort of in retail sales and those sorts of things, but not diabolical slowing. So we're looking for a reasonable reporting season. It's not going to be a shoot the lights out one by any stretch of the imagination, but we still think there'll be some good dividends out there. And how are we going to generate them? Well, this is where we're very active, and we actively will rotate or buy stocks and hold them for a couple of months to get dividends. Once they've gone X, or we've held them for the required 45-day rule, we reevaluate whether we want to own those stocks, and if we're only in them for the income, then for the dividend, then we'll move on to another stock and buy that, and we'll continue to do that. There are always opportunities. So whilst lithium miners are down in the dumps, and the banks have rallied very strongly, but their dividend outlook's pretty flat, to be honest. Yeah. But we expect some pretty good results from the insurers, so we'll be actively operating in that area.
Absolutely, absolutely. And Donald, I hear obviously going on your summit series. Where could potential investors and fund managers see you along the way?
Well, in the last couple of weeks of July, I'll be presenting at the Pinnacle Summit in all the major capital cities, apart from Hobart. Well, we'll also be in the Gold Coast and Newcastle. So Adelaide, Sydney, Melbourne, Perth, Brisbane, Gold Coast and Newcastle over the next couple of weeks, myself or one of my colleagues.
Lovely. Yeah, excellent. It's going to be a very busy time for you.
We'll be busy, and then we hit reporting season.
Yeah, absolutely. Absolutely. Well, thank you so much for joining us today. If anyone has any further questions, we're happy to submit it. But more or less, Donald, for those that pension investor, what's your comment that goes out to them today?
But sorry, for pensioners, or
yeah, for the investor that's in pension phase that wants to be looking at sort of stocks like in your sort of field, why PL8?
Well, I suppose what we feel is that PL8's a diverse. If you look at it as its investment strategy, it's a diversified portfolio of income stocks actively traded, and the income stream from that is much more reliable than if you were just to jump into a bank or Telstra or BHP or what have you for the income. It's more volatile. They can cut their dividends at any time. What we're doing is buying the best stocks to get the dividends, and that has enabled us to give a smooth income stream rather than a lumpy and somewhat volatile stream. When we first listed, Telstra was an income darling and of the market, and then within the first year or two of PL8 launching, Telstra cut its dividends by nearly 50%. Whereas we were able to grow our dividends in PL8. So I think a diversified portfolio of stocks pays a much more reliable dividend stream than just buying one or two stocks.
Absolutely, absolutely. And that is some great comments to lead us off on. But thank you so much, everyone, for attending the webinar today. We look forward to having a bit more conversation later down the track. Obviously, if you have any questions, please send them through to Donald. I imagine he'd be very happy to answer those. But apart from that, if you've missed the start of this will be up on YouTube, so you can have another look into it and see it once again in our replay. But thank you very much for attending today.